Okay. Good morning, everyone. Welcome to this webinar, this first session of the series of webinar that we are going to do. And the main topic will be financial literacy. And we are more than happy. The idea is to start with the basic, very basic concepts because some of you, like me, are starting their journey to understand how finances work in Canada. I'm going to introduce myself and then we will jump into the main topic. I'm Mause Foliavli. I'm an IT guy. Many people have known me. People who know me for years know that I started as an IT guy. I'm still an IT guy. It's just that I'm adding a financial layer to my professional knowledge. So, let's dip into it. We will have time to discuss more about me, but you can follow me on LinkedIn and all my different channels if you want to know more about myself. Now, today the idea is to talk about financial independence. I know you already know what it is, but sometimes there are some basic little things that we miss. So, quickly, what exactly are we thinking about when we say we want to work towards our financial independence? The second topic is the different ways we manage risk in our life. You are already doing it. It's just that you may not know the different ways and reasons why you may go for one strategy rather than another one. The third topic will be the financial independence pyramid. You'll see what it is in the next minute. We will also quickly talk about the X curve concept, what it is, wealth versus responsibility, and then also the compound interest and time value of money. What is simple and compound interest? In Canada, you cannot skip taxes. What are the different ways of tax application? Because these are the knowledge you need later when you want to plan for your finance. We will also quickly go through the wealth formula, so the different components that you have to keep in mind. Then, obviously, habits and a quick recap before we go. So, let's jump into it. Now, when we say financial independence, for me, it comes back to why do you want to save? Why do you want to make money? The reasons may be multiple. It may be because you want to travel, because of your family, because you have kids, you want to work towards their education, you want to plan for your retirement. Reasons are many. However, you need to sit down, you need to have it written somewhere. Ideally, you have to categorize them into three: short, mid, and long term goals. This is how you know what you have to do now if you want to reach that financial independence level. Again, what I'm sharing here is not new. I'm not the first talking about it, but it doesn't mean that you are already doing it. So if you're not doing it, keep in mind that it's not optional. This is what you have to do, right? So you need to know why, and that's also the motivation that will keep you going, even if you fail this week or this month, you did not reach your goal. At least you know what you are working towards. And when you have people in your environment, when you're talking to people, when you're attending events, you quickly identify what is an opportunity for you because you already know where you are going. So that's it for the financial independence, which at the end of the day is the reason why you are trying to make money or save money. Now, the next topic is the risk management strategies. We have mainly four ways to manage risks. The first one is to avoid the risk. So if you are afraid of car accident, for example, if you want to avoid car accident, one way of doing that is to avoid taking cars, because every time you take a car, you potentially have to handle the risk of an accident. So avoiding the risk is completely not going towards any opportunities that may lead to that risk. The second one is to reduce it. So again, if we take the example of car, you, by following the rules, by checking that your engine is working properly, your car is in good shape, you are reducing car accident risk. The third one is to return. So you may say, I'm okay. I don't really care. I'm a lucky guy. I'm born lucky. So you can return, you can decide not to do anything. And sometimes it's not because you do not want to, but it's just that you don't have the means or you don't think it's a priority. But not doing anything, it's also a strategy, which is the return strategy. And the last one is to transfer. So if you transfer the risk management, it means that you are delegating the management of that risk to someone else or another entity, which is what you do when you take, for example, an insurance. If you take a car insurance, you are transferring the risk management to an insurance company. Okay. So all these different strategies are okay, they're fine. It's just that you have to know, you have to be aware of the risk, you have to know what you are planning for that risk, and that's it. You are not obliged to take insurance for all the risks. You do not want maybe to transfer all the risk management to other entities. You may retain some of them, you may avoid some of them, you may reduce some of them, but again, it's good to know the risk, it's good to know the strategy you want to apply. And yeah, that's it. Now, the next topic is the financial independence pyramid. Now, you may see four layers somewhere, and I've added another layer based on my experience since I've started this journey. Now, um, I'll start with I'll say the first four layers, and then I will explain the one at the very bottom, the reason why I've added that one. So usually, we start the job, we save money, or we have a good salary or a good opportunity, and the first thing we want to do usually is to invest that money. But especially here in Canada, you cannot plan, for example, job security. You cannot be sure of how secure your job is, for example. So it's better you take you decide from the strategy to handle that job security aspect, for example. So what we call proper protection is everything related to your income that you're having. You may be self-employed, you may be employee, you may, no matter how you manage to pay your bills, handle your expenses, there are different ways to protect your income. That's what we call proper protection. It can be insurance, it can be life insurance, it can be critical illness, it can be disability insurance. There are different ways, but it's good to plan, to have a strategy to protect your income, because anything can happen. The next level is your debt management. It's very hard, very, very hard to become wealthy if you have debts. I don't know how you're going to do it, but from my experience and from what I've seen here and there, you cannot become rich if you have debt. I know, depending on your strategy, you may go for some debt, which will be categorized as investment. But if it's a passive debt, let me call it passive debt, debts that you cannot control, then there is an issue. So, for example, your credit card debts, uh, your mortgage, your your car loan, for example, these are debts you need to be careful about because of the interest related to that debt. So, debt management is something you need to work on. The next one is emergency fund, which is also linked to proper protection in a way. So, ideally, again, because of job security, because of anything that can happen that may affect your financial plan, it's good to have 3 to 6 months. Now, it really depends on you. You may, sometimes people will advise more than 6, minimum 3 months. And it's because depending on what you may face as issue, um, you may run quickly out of money if you just rely on your savings account, on whatever you have aside. Now, they also, what I want to add here also for the emergency fund is that the way it helps, or the difference between just your savings account, is that you have an idea of the amount you are targeting. You are not just saving because you want to save, because you are someone who is able to save money, but you are saving because you are targeting a certain amount, which may be 3 months, 6 months, or more. So having an emergency fund helps a lot. You are you are calm when you have to take investment decisions. You take it without being emotional, without fearing, without if you have a situation, you won't run and withdraw your investment capital or things like that, right? And obviously, the last layer is the investment, where you invest your money. Again, from what I've seen, from what I've experienced so far, investment takes time. So you do not want to invest the small amount you have in that portfolio or in that layer only. Now, as I said, I've added a fifth layer, which is the financial literacy. Why? Um, what I've noticed is that even if you are not a financial advisor, even if you are not an insurance agent, even if you do not have the background of someone working in finance, even if someone is advising you, in order to help also that person, it's good to have a basic financial literacy knowledge. And for me, it's very important, not because you want to become expert, but because you want to plan, or again help your advisor take the right decision. In the upcoming sessions, I'll go over what we do as a financial advisor or insurance agent to explain you better the challenges. It's an art, it's a craft. So, just like in French, we say, il y a plusieurs chemins qui mènent à Rome. There are different ways to do the same thing, right? So for me, it's important for you to also invest your time and energy in financial literacy. Again, 5 layers: financial literacy, proper protection, debt management, emergency fund, and investment. Now, the next one is this concept, which is also good to know. The X curve: responsibility versus wealth. When you are young, when you are in your 30s, 40s, you have more responsibilities. And usually you do not have money because you are handling different projects. Maybe car loan, maybe your mortgage, education for your kids, etc., your hobbies, etc. Now, if you plan well, what happens is that by the time you retire, by the time you get older, you will be able to have more money because kids will also hopefully have succeeded. They will Kids will get married, they will become independent. You have you eventually you'll be done with your mortgage, all the loans that you have as a responsibility that were taking your time, energy, and money. You'll be done with all those projects. So you have more money, you have more time, you'll be more independent. Now, that's the ideal path, that's the ideal roadmap, but you need to be aware of it and you need to plan accordingly. Uh, in other countries, I may say this may not work 100% because it's not because you get older that you are automatically independent. It's something you have to work towards. But ideally, this is how it works. And if you know it, then you will know how to plan accordingly. Now, the next one, the next concept is the compound effect of money. It's very simple. Okay. Now, there are different consequences to this principle. But if you understand how it works at a very basic level, you may also know how to use it in your advantage. So the compound effect of money, in this table, for example, we have compared a simple interest schema and then a compound interest one. If it is a simple interest, you'll see that what you have in 30 years, if you are investing $1,000, will be 2005 for an interest rate of 5%. And if it is a compound interest, you have 4,321 something in 30 years just because it's compound. I don't want to go too much into uh, the mathematics or the algebra behind that, but just understand that if you are investing in a vehicle that has a compound interest schema, it's better because the way you will make money or increase your money is much better. Now, what are the situations related to this principle of compound effect? The first one is if you want to know, for example, in which year or after how many years the money you are investing today is going to double, you divide 72 by the rate of return. So if you divide, if for example, your interest rate is 6, if you divide the 72 by 6, you have 12, which means that in 12 years your capital will double. Now, it also means that if you have a debt with an interest rate of 6%, what you owe is going to also double. Okay? So it depends on who is applying it. The person, the lender, is going to double his money, but you'll be the one paying for it. But if it's you who is investing, then your money is going to double. So it's good to know. And this is a concept that will help you, for example, when you're applying, when you are working on your debt management. Okay. The second thing I can also mention is the power of early investing. If you invest early, then definitely you'll be able to take advantage of this compound interest. Okay. The next concept I want to share is related to taxes. Here in Canada, even if you do not know anything about taxes or you have been paying taxes, but the good thing here is that every day something is going to remind you this concept of taxes. So we have three ways of applying taxes, or taxes are applied in three different ways. Taxes are applied now, later, or they also we also have vehicles which we put under tax advantage ones. If we take tax now, we have your checking accounts, GIC, savings, your salary. They are all taxed now. Tax later We have RESP, RRSP, pension, etc. Don't mind the vehicles I'm mentioning. If they are new to you, it's okay. We will have other sessions where we will go into details, but just understand that for example, RESP is the savings account you put money in for the education of your kids. RRSP is for your retirement. So those accounts are taxed later, which means that when you put money into those vehicles, you do not pay taxes now. It's when you withdraw money later that taxes will be applied. And for tax advantage, as the name is stated, we have TFSA, life insurance benefit, disability insurance, for which you do not pay taxes. And knowing or understanding how this works helps you when you're applying for your finance. So, for example, you may say, I want to put my money in a tax later vehicle because I know that by the time I will be taxed on that money I'm putting in, my tax bracket will be lower. So the tax you will pay will be lower. Just to give you an example. Now, the next concept is the wealth formula, which is the sum of all we have seen so far. So if you are able to get money to invest, if you plan well, so you take advantage of the time, if you also consider the interest rate related to the vehicles you are using, if you also consider how you want to handle the tax applied to what you have selected, and in addition to that, you consider inflation, then you'll be able to have a proper plan to reach your financial independence. Now, inflation, I've not mentioned it because for me it's so obvious. You will every day when you go for shopping, you will notice the prices increasing every time. So it's not something someone has to explain to you. You already know it. You can feel it. And when we are doing financial planning, we usually use the rate of 3% to when we are doing calculation. It's just an idea to plan. It may be higher, it may be lower, but on an average base, we usually use 3%, right? So money plus time plus or minus interest rate minus tax minus inflation gives you a better net idea of your wealth. Now, you understand the concepts, but there is something key, something important you cannot avoid is your habit, is what you do every day. This is how you can make sure you are properly working towards your goal. So if you are careless about your credit card, if you're careless about what you're buying, if you're careless about, you need to take a look at your habits. This is a must. You cannot, I understand sometimes you can, you log your your hobby is maybe nice cars, your hobby is maybe nice clothes. For me personally, it's okay. You just need to be aware of it and you need to plan accordingly. If that's what motivates you, that's fine. But you need to know what is your priority. If in 10 years you know you can reach your goal without changing your habits, that's fine. The main objective is to reach your goal. If you know you have to make some sacrifices now, then it's also a decision you have to take in order to move forward. Now, I think I've gone through the basics. A quick recap here. So we've talked about financial independence, reasons why we want to save money or invest, or the different decisions that we are taking are related to the reason why we want to work towards our financial independence. The second concept is the different ways we manage risk. The third one is the financial independence pyramid, the 5 layers. Then the X curve, wealth versus responsibility. And then the compound interest, how it works, how we can use it in our advantage. Then taxes, the different categories that we have here in Canada, the wealth formula, and obviously habits, how we have to be aware of it and plan accordingly. So that's it for today. Again, as I said, this is the first session. I just want to start slowly with the basic concept. The next one probably will be focused on the role of an insurance agent. What exactly is this business? You as a client, what do you expect from an insurance agent or your financial advisor? Uh, there is a lot. We have myths, we have so many things about it. I also have doubts about that before joining this, so I'll be able to share more light about what it is. You can follow us on our website mfinspires.me, on our YouTube channel, on LinkedIn, or on Instagram. You can scan this code. um I will eventually put a cheat sheet in under this video, and in all our channels, in case you want to quickly review this concept if you do not want to watch the whole video again. So yeah, that's it for today. Thank you for joining. Take care and see you next time. Bye bye.